the private credit concern is massively overblown. What we're seeing is mispriced fear, not deteriorating fundamentals. I'm pleased to say that we're joined live by Erik Hirsch. He is co-CEO of Hamilton Lane, an alternative asset manager with about $1 trillion in assets under management. Erik, great to have you with us. So let's start there, because the conversation that we've been having on The Close is really trying to untangle the sentiment that we're seeing in private credit right now from the actual fundamentals. But, you think about the very human reaction, just human psychology at work. You see all these negative headlines of investors being gated, not getting all of the money that they would like redeemed back. I wonder, in your view, what that might mean for fundraising for this asset class going forward.
Well, Katie, nice to be back with you. I think you laid it out perfectly well, which is you have a huge headline issue. No one wants to wake up every morning and be told there's an issue, there's an issue, there's an issue, because when they hear that, they want to do something about it, i.e. get out or avoid the issue. And so that's very different than what we're seeing at a fundamental level. You said it before. You're talking about an asset class that's almost $2 trillion. So inside of that, it's hard to lump everything together. So I like to think about sort of these private market firms like cars. We would never say we have a car problem. We would say, well, there's a problem with this particular manufacturer or this particular model, or there's a problem with this driver driving the car too fast or with too much risk. And I think that's what's being lost right now, is that nuance of talking about cars and specific models rather than saying everything is a problem.
I really want to dig into that metaphor. So, what do you think is the issue here? Is it certain brands, meaning, asset classes, in my view? Is this a private credit problem? Is this a situation where the drivers are driving too fast, where the managers maybe are taking on too much risk, or maybe didn't properly disclose some of those liquidity requirements?
Well, I think there's a couple of pieces. One, I think different car manufacturers build different quality of cars, and not every driver is equally adept at being an excellent driver. So I think it's the combination of those two things. But we also need to recognize that private credit is lending to all kinds of different businesses. So right now, the headlines would have us believe that private credit really just lends to software companies, and software companies are in trouble. Well, that's just not true. Software makes up a very tiny portion of the overall private credit market. There's a lot of private credit that's being lent to industrial companies and manufacturing companies or retail companies or rolling up dental practices. Those are very different risk profiles, and those are impacted by very different economic fundamentals. So a whole bunch of that is going to have zero impact from AI, and some of that will have impact, and some of that's going to benefit, and some of that will be harmed. But again, the asset class is so large, and the amount of industries that capital is flowing into from the private credit market is so vast that it becomes really hard to paint with a broad brush, and right now that brush is very, very broad.
But Erik, I can't help but think back to a few weeks ago when the president at PIMCO said, quote, "It's not just a crisis of confidence, it's a crisis of really bad underwriting." Is that just idiosyncratic to your point? Is that just one or two car manufacturers not doing their job?
I absolutely see it. So you think about Hamilton Lane's sort of vantage point here. We're able to look across thousands of private fund managers, including hundreds, if not thousands, of private credit managers, look inside their portfolios, see what they've lent to, see the businesses, see how those companies are performing, see how the credit is performing. Is it cash pay? Is it PIKing? What's happening there? And as we're looking through these portfolios, again, some not great car manufacturers, but saying that there's an issue across all of that is just not what the data is bearing out at all.
But Erik, just thinking about looking at some of these portfolios, how much of a concern is it that a company that today is no longer software that maybe 2 months ago was categorized as software?
I think there's going to be some concerns around that. And again, I think you're going to certainly see some software losses as a result of AI. But we also need to recognize that there's a lot of equity cushion sitting in front of the lenders. And so you're going to need to see outright bankruptcies in some cases where there's zero recovery value for either the equity or the credit to actually see those losses flow through. A firm that was bought for $1 and is ultimately realized for an equity loss because it sells for 75 cents, the credit's in fine shape there. And again, I think that nuance is being lost as well here.
I'm trying to think of another car metaphor, but I'm coming up short. So I'll just ask you a real question, which is, you think about a lot of these headlines, the headline risk that we've been talking about, a lot of it is concentrated to private credit specifically. I mean, from your perch, from your vantage point, how does what we're seeing in private credit compare to what we're seeing in private equity or in real estate or in real assets, given that, private markets, that's a very broad church.
Very broad church. So I think we should look at a couple different behaviors. One, let's look at what the institutional investors are doing, because the notion that the institutional investors are not investing in evergreen is also not accurate. So the evergreen vehicles and the BDCs that are sort of the headlines today, there's a lot of institutional capital sitting in there. And what we're not seeing is we're not seeing the institutional capital redeeming nearly at the level that we're seeing the individual investor. That sort of says to me, sophisticated, longer term, less frightened by headlines, more rooted in data, and they're voting with their feet and they're staying. In some cases, you're seeing large amounts of institutional capital moving into the private credit space right now, which is something that we're not at all sort of seeing in the headlines. The whole notion is everyone's trying to get out, and again, that's not what the data bears out. And in other cases, on the retail investor, when you're seeing them redeeming from private credit, they're not abandoning the private markets. They're in fact just moving into other sub-asset classes, infrastructure, venture capital, equities, but they still want to be exposed to the private market for good reason. You opened the show talking about the OpenAI round. Well, $3 billion of that financing round came from individuals who want exposure to private, non-publicly traded businesses because they see real opportunity there for return.
Yeah, it'll be interesting to continue this conversation. Obviously, the ever-evolving world of private credit. Thank you so much to Erik Hirsch. He is co-CEO of Hamilton Lane.